Welcome to Kitco News. I'm Niels Christensen, and welcome to our continuing special coverage of Mines and Money Online Connect Virtual Mining Conference. Here to talk about the Federal Reserve, gold volatility, mining, everything under the sun is Adrian Day, President, Chief Executive Officer, Chief Investment Officer of Adrian Day Asset Management. Adrian, it's a pleasure to have you back on the show. Thank you very much for joining us today.
Well, thank you so much for having me. It's good to see you again.
It is really nice to see you with you. And as we were talking online, the last time we talked was in March at PDAC. We were talking about, whether gold can go over $1,700 an ounce after the Fed surprised markets with a 50 basis point cut. Today we're going to continue to talk about the Fed, so nothing's really changed except for the price of gold. But yeah, I mean, what do you think? Does gold have what it takes to end the year above $2,000 an ounce, do you think?
Oh, absolutely it does, yeah. And it's funny, Niels, I was going back over a few interviews or comments I'd made in March and April, and, I was being reasonably aggressive saying, I really do think we could end the year at 1900. Yes, it's possible. And it didn't take long. I think the important thing, you've said this before, many people have said this before, we always say, well, what's the price of gold going to be? We should really ask, what's the price of the dollar going to be against? So I definitely think we could see new highs before the end of the year, absolutely, and stay over 2000. And today we've got a tiny correction. I hope no one's freaking out about, $30 on a 1950 price.
Well, and a lot of this volatility has been caused by the Fed in that, we saw the Fed minutes come out, gold lost its $2,000 an ounce level after the Fed said they don't see the benefit of capping yields right now. And then we hear Jerome Powell, Fed chairman, talk at Jackson Hole about this new monetary policy regime, about, an average 2% inflation rate. How do you look at this volatility? How do you look at the Fed? Do we care about the nuance, or we just care about the fact that interest rates are going to remain low for the foreseeable future, and they're going to do nothing but shovel money into financial markets? Is that what we need to pay attention to?
I think you've said it perfectly, and everything else is nuance, as you say, and everything else is words, frankly. And we've seen this from the Fed so many times before, after QE1, 2, 3, and then after they attempt to pull back. But the actual reality of how far they pull back is always very, very minor, and is much smaller, much less than what they intend, and I think than what they actually intend. But they simply cannot pull back for one reason or another. Sometimes it's just because the market gets a hissy fit. Remember the end of 2018? Seems so quaint right now, doesn't it? So long ago. But, the Fed started to raise rates. They had already stopped increasing the balance sheet. They started to increase rates, and the stock market had a hissy fit, and they immediately reversed. Any excuse or reason, however you care to put it, I care to say excuse, but any reason, whether it's Brexit or whether it's the stock market or whether it's whatever, it doesn't matter. There's that expression, when you're a hammer, everything looks like a nail, and that's the way it is with the Fed. And I think one thing that's really critical for us to understand, Niels, one thing's really critical is a lot of Fed apologists are saying, well, look, nobody could have expected Corona, for goodness sake. That came out of the blue and the Fed had to react. Let's not forget that from September 2019 until February 2020, when Corona, as far as most Americans was concerned, was a Mexican beer, during that time, You had the fastest rate of growth in the Federal Reserve balance sheet ever, the fastest rate of growth prior to Corona. So Corona didn't cause this explosion. Something would have happened sooner or later to cause it. And I think the problem now is I think we've reached a point of no return. The Fed is out of control. Jerome Powell himself has said, there are no limits. There are no red lines. Jerome Powell has said, we are not even thinking about raising rates. And as for the balance sheet, Powell himself about a month ago said, I don't think we will ever reduce our balance sheet. We will simply let its size in proportion to the economy reduce as the economy grows. Whoa. So the Fed isn't even looking at tightening now. It can't do it. So it's just a matter of expanding, halting, expanding, halting. And that is about the most positive environment for gold that you can possibly think of. And if gold goes down for $30 one day, it just doesn't matter. It's irrelevant.
Mm-hmm. And what about the fact of, like, are you worried about diminishing returns in that, the Fed does all of this, and like we saw when they raised their balance sheet, which was only a couple months after they said it was on auto. The shrinking was on autopilot. A few months later, they start expanding it again. But I'm sort of wondering, and we saw that, just before we saw that have limited impact on economic growth. So I'm sort of wondering, do we, if Fed policy has diminishing returns on promoting growth and economic activity, do we need to start looking at fiscal policies in that, government spending now is going to drive growth? Is that sort of the next area?
Yes and yes. Stimulus, we mentioned this in March, I remember. Stimulus is like the drug addict. You need more and more drug, more and more stimulus to get the same high. And we have seen that certainly QE1, 2, 3, now QE infinity. We've seen that. But in answer to your question, the second question, yes, absolutely. I mean, this is modern monetary theory, MMT, which is neither modern nor really monetary and not much of a theory in my view. But that's exactly what's happening now. The government, whether it's the administration or Congress, is spending money out of thin air. There is not even the slightest pretense that we're going to pay for it. No one's even talking about that. I mean, at least in the past, people said, well, we'll have a deficit now, but we'll pay for it later, or we'll have to raise rates to pay for this or whatever. They're just creating spending, and the Fed is, they're just spending, and the Fed is creating the money to go along with it. And the question I have for people is Congress and the administration, frankly, because they're just as bad, is what I'll call the government, is the government going to stop spending money on stimulus? Are they going to say, I mean, for Democrats and Republicans to be arguing about extending the unemployment is frankly, it's pathetic. It is truly pathetic. And of course, President Trump has absolutely no constitutional authority whatsoever to get out a pen, as Obama liked to say, but we've forgotten that. I have a pen, and by executive order, extend unemployment benefits. He has absolutely no constitutional power to do that. But I thought it was a great slap in the face of Congress. So they're going to extend unemployment. They're going to extend stimulus. And what's the Fed going to do? Is the Fed going to say, well, you know, in March and April, we created the money to accommodate you, but this time you've actually got to behave like responsible budget people, and you've got to find the money yourselves? Of course not. Of course not. The Fed is going to continue to create the money, and whether it's unemployment benefits, whether it's a new works program or infrastructure program or whatever, the Fed is simply going to create the money without even a pip of objection. We know that. And so this is incredibly bullish for gold.
Well, okay, so we're looking at gold prices to end the year above $2,000 an ounce. What does this do for the mining sector? I mean, is this now the time to get into mining? Have we missed the boat for getting into the equity sector? What are your thoughts on that?
Is it the time to get into the equity sector?
Yeah, in the mining sector, in mining equities.
Absolutely. I mean, here's the thing that's astonishing. Gold is at new highs. Plus, you've got an incredibly bullish outlook. You've got gold under-owned by many investors, institutional and retail. So the outlook is good. And yet the stocks, when you look at them, they are far below the prices they were in 2011-12. They are in the lower quartile in many cases in terms of valuation, whereas with gold at new highs, typically you get multiple expansion. You expect the gold stocks to be trading at higher multiples when gold is at new highs and looking positive. So the stocks are still remarkably cheap. And I think that's simply because, they fell so far. Think about it, the XEU was down over 80%. I mean, that's pretty dramatic for a major index. And so it just takes a long time for these prices to catch up. So anyone who thinks that they have missed the boat on the gold stocks, I think couldn't be more wrong. Now, the prices are not as good today as they were, 6 months ago or a year ago. Of course not. But they are still very, very undervalued, the gold stocks. And that applies to the senior miners, which are obviously always the first to move. But it still applies to the senior miners. It also applies, to the smaller miners, the intermediate miners, the single asset producers, as well, of course, as the exploration companies. I mean, everything is cheap, except you might say the major royalty companies. But I'm a big fan of holding the royalty companies as core holding.
It does feel like we are seeing sentiment change in that, even generalist investors, Warren Buffett, Berkshire Hathaway, are recognizing mining as a viable business. They are creating a product that is increasing in value. If a t-shirt company, sold, managed to make t-shirts at a lower cost than they were selling it, you would say that's a viable business. And I think we're seeing that in the mining sector now, finally again, after how many years of neglect.
No, good point. That's a good point, and absolutely. And I think the other thing people are recognizing increasingly, including generalists, is that it's very, very difficult to find new ounces. All of your guests talk about this, of course, but I think it's critical for people to know that it is very, very difficult to find new ounces, and particularly major deposits. And so we are simply, as an industry, we are simply not discovering every year what we are producing. And if the outlook for what you're producing is a positive in terms of price, and you simply can't yank up the what I'm trying to say,
the soil, the ore, yeah.
Then that's very, very positive for major mining companies. And it in fact gives them that famous moat that Buffett likes to talk about, because you can't have new entrants just come in and start creating gold from, it's just not there. So yeah, no, and the other thing we should recognize, it's been said many times, of course, but it's still a theme that's worth recognizing, which is that for the most part, the major mining companies are better disciplined today than they were back in 2010, 11. I'm a cynic. I think that will change when gold gets to 2,500. We'll have all these crazy overpriced marginal assets. But for now, the companies are much more disciplined. So if you're a generalist like Buffett and you look at Barrick and you look at the management and you look at their mines and you look at the quality of the ounces, it's a very, very compelling investment.
Adrian, this has been a fantastic conversation. I always enjoy talking with you. Like I said offline, we need to get you on Kitco more than twice a year, but thank you very much for your time.
Well, thank you very much for having me. I appreciate it.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.